Folks, welcome. I am giving you some behind the scenes footage of how this future $1 trillion operation works. So here you go. This is our forum. And this is what we do. Very high-tech stuff. Bam. We are live. Welcome. Welcome. Just wrapping up my producer duties, transferring over to my duties as a online influencer of at least 2 or 3 people who I pay for to appreciate me online. So let's get to it. What we're going to talk about today is other markets. Really, what I want to focus on is not so much the daily charts. I want to focus on the weekly charts and the head fakes that they can give us once we get a rally on a daily basis. We think that all is clear. It's safe to go back in the water, and all of a sudden you get a rug pull, right? So usually what happens in a correction or a bear market is that there's something called a turnaround Tuesday, meaning you get a very big sell-off on a Monday, then the Tuesday you have a rip your face off counter trend move, and then all of a sudden Wednesday you resume the downtrend. It's things like that, and what that does is that really compounds the bear market. It compounds the selling, because what is happening is that you're going from a bullish optimistic behavior of buying the dip to one where you're afraid to buy the dip and that they're selling the rip. So we may be setting up for that, we may not be. But what I want to do is I want to take a look at the weekly charts in particular tonight and take a look at each index, each sub-sector, and take a look at what is it telling us on a weekly basis, and are we setting up for a reversal, a resumption of the bull market rally, which we're technically still in. Anybody that says we're not in a bull market, they are wrong. We're in a bull market. It's damaged, it's not broken. But we're close. We're very, very close. Now, what season we are in is silly season. And what silly season is earnings season. What happens during earnings season? We get earnings that come out. Companies will beat or meet expectations. They don't tell you on CNBC that if a company beats, I'm going to say Taiwan Semiconductor because it was up today. I don't know if they reduced their forward-looking guidance last quarter, but they won't tell you. The CNBC won't tell you they beat on already reduced forward-looking guidance. So it's not as if their earnings per share rose quarter over quarter, year over year. It's just that they beat on expectations. And it's expectations by the market or by the analyst community. And it is used as a megaphone, or that information is treated by the media as a megaphone of sending out a message that all is right with the markets. You got to continue buying stocks because companies are beating on estimates. And what's in it for CNBC? What's in it for Fox News? Advertising. They know that in a bull market, you have more eyeballs, they charge more for advertising. In a bear market, the exact opposite happens. So it's in their vested interest to keep the bull market going for as long as possible. There is a conflict of interest. So we're in silly season, and they're going to do anything possible to take the worst earnings report and try to spin it into something good. And what will happen is that after you get a good earnings report, you're going to have every earnings brokerage house coming out and raising guidance, raising their price target for the stock, and it's a multiplier. So you get the beat on earnings, you get the media that announces it. They don't tell you that it's a beat on lowered expectations, and then you get the brokerage houses raising their expectations, getting everybody excited. So the question is, as earnings come out, how do we know whether or not stocks are any cheaper than what they were prior to earnings being released? That's the big question. That's the litmus test. That's the report card. So when we get 3/4 of the way through earnings season, that's most of the S&P 500 will have announced. Not even 3/4 of the way, halfway through, you're going to know how earnings are influencing the multiple on the S&P 500. So that's what we're going to be looking at in the coming weeks, even more closely than we would normally, because we want to know what the numbers are telling us. Is the market cheaper today after the strong earnings numbers that we got this week any cheaper than it was on Sunday night? The answer is no. Should we expect that the earnings that have been reported thus far will have influenced the PE multiple on the S&P 500? Maybe, maybe not. You know, I've had some big banks come out and they've reported some good numbers. It's a little bit too early. I don't want to be that critical of the system yet. I will be, because in all probability, as tech gets reported, and that really begins not so much next week. You get Netflix out next week. I'm calling it tech because it's in the Mag 7 space. But the week thereafter, we're going to have a really good idea of how earnings are influencing the Shiller PE ratio. If we see earnings come out and they're rallying the market or keeping it steady, even worse, keeping it steady, and you see the Shiller PE ratio, and this is a rear view mirror look at the multiples that have been reported, or the valuations or the earnings that have been reported, and then you get the forward-looking PE. A lot of brokerage houses are going to base their forecasts on equities on a forward-looking basis. We look at both. We're going to look at both. How is it changing? And should we be any more bullish today or this week relative to the prior week with the earnings that have been reported? It's pretty simple. It cuts right through all the BS from CNBC, from the earnings calls, the conference calls, and from the brokerage houses raising their guidance for prices. So with that being known, that we're at that time of the year, it happens 4 times a year. It's the same thing over and over again. The question is, structurally, how is the equity market set up? Is it set up for a continuation breakout to new all-time highs? Or are we on a 3-legged stool where if one more leg gets taken out, that balancing act comes to an end real quick, real fast? And that's what we're going to talk about tonight. So let's say hello to folks. Hopefully my audio is working well. George, welcome. Jody, the lovely Jody. RB, happy Thursday, Bob. Can you please take a look at the video? RB, please put it in the here, I'll put it in for you. It just helps me keep track. Can't say we're not a full service outlet here. There we go. I'm going to cheer my own entry. You're all good to go. Polish Taco, welcome. Oh, you know what? I put this in the wrong. No wonder why nobody's posting. I put it in the wrong area. Sorry, folks. My bad. My bad. It's supposed to go here. I was wondering why we weren't getting more pings. There we go. There. UVA. There we go. Okay. So if you're already in the forum, please, or sign up for the forum, enter your symbols there, and we'll go over them. And Donnie, yeah, I put out a note earlier that we weren't going to have a call today. Here's the link. Where's the link? Here we go. If you're not a part of the forum yet, all you need to do is click on that. No, you're not going to get asked for a credit card. How kind, sir? 25 coming. Are you with me? I don't know what that means. How kind, sir? 2025 correction coming. Oh, is a correction coming? Are you with me? All right. I think yes. That's my personal opinion. I think yes. I don't think that we are in for a honeymoon period with President Trump taking the reins. I think that we are in for revisions. And what I mean by revisions, members are going to be like, oh my God, here he goes. Because I repeat this all the time. They're probably sick of me saying it, but it's the courage of our convictions, and that I believe that what we're going to get after the election is a big, big revision to economic data. And I would pay particular attention to the jobs data, which I don't believe in a minute. So if that begins to happen, then we're looking at recession. And all right, Sean's in here. You betcha, Mr. Sean. Then you're looking at recession. So yeah, to your question, I'm worried about. I'm putting the guy to sleep. Sorry about that. I'm worried about revisions and the impact on the market. Thank you, kind sir. You have okay. Very good. Larry, welcome. Looks like younger than 59. She's a Scorpio. November 6th. Pam Bondi's 59? She looks great. What do you mean you can't? Donnie, you can't get into the forum? Try it. All right, I'll do it offline. I don't want to expose people's personal information on online. Donnie, what's your? I already entered it, so it's on there in the video, right? We'll take a look at it. We'll get you set up. One of the moderators might have accidentally blocked you for whatever reason. We'll get that fixed. All right, Corey, welcome. TZ Burton, welcome. Who else do we have? That's pretty much it. Thursday's a pretty quiet night. So let's get to it. All right. So we had economic data that came out this week, and it's a mixed bag. And we had NFIB small business optimism that came out yesterday. That's a small business optimism. Came in better than expected. Producer price index missed, came in with a soft number. At the core, it was the third of what they expected. and we had the subsequent rally. Now, today we got the CPI that came in a tick hotter on the headline number. That's what they report on CNBC. But the core number showed a decline, or I shouldn't say decline, a miss of expectations by about 1/3%. Core year over year, and this is probably the reason why you saw the selling today, was still pretty hot. And then you got, actually, core was yesterday. I'm sorry, the CPI was yesterday. Then today you got initial jobless claims. That came in hotter than expected. In fact, I think that was the highest read on jobless claims in a couple of years. So that's a problem. Retail sales, that missed. That's a problem. The headline's kind of misleading here. They missed, yet it's saying a robust quarter, month, I should say. Retail sales minus autos, that came in as expected. Import prices, that's a major problem. Import prices came in a lot hotter than expected, and we import a lot. Remember, the manufacturing sector here is dead. In fact, the Philly Fed manufacturing survey is below 50. That's a sign of contraction. Tomorrow, we get housing starts, building permits. That's more of a forward-looking indicator, and that is economic data. So what happened today with the expectations of a rate cut? Nothing. There's no move for the past couple of days. I've never seen the Fed Watch tool this stable. Nobody's pricing in a cut in January, March, no bueno. May, this changed. May changed. This was below 50 last night. Now it's above 50. It was June where they were pricing in the first rate cut. I think Goldman came out today and they said they expect 2 cuts on the year, one in June, one in December. Now, as for the Buffett indicator, strongly overvalued. That's no change there. So this is a threat to the market. We already went over the Schiller. On a forward-looking basis, so this is the rear view mirror basis. How earnings have come out. How is the market priced on prior earnings? Now, on forward-looking basis, on forward-looking estimates, the forward 12-month PE multiple on the S&P 500 of 21.5 is above the 5-year average of 19.7. Not ridiculous. And above the 10-year average of 18.5. A little bit expensive there. So, what I like to do is take a look at historical trends. Are we at a resistance level? Yeah, we're at a range where typically the equity markets begin to roll over. So I'm not getting the warm and fuzzies, and this is something that we're going to want to pay attention to quite a bit, because while the Schiller multiple may continue to stay stable or increase, the forward-looking number may decrease, and traders may take the market up in spite of the rearview mirror PE multiple. So we want to keep an open mind, understand what traders are trading off of. We use both. And ultimately, I think it all gets decided by this. What's the market trading at, and what is the catalyst? Whether it be poor forward-looking guidance, poor economic data that ultimately says, you know what, the market's too priced for perfection. The news that we're getting does not substantiate where the equity markets are right now, and it's time for a correction and probably a recession. Now, the yield curve is on the week now flat. I thought this might be down today because we pulled back today on the yield curve, and we pulled back even further yesterday. So today we may have finished out flat, and yesterday we wiped out most of the gains on the yield curve. Folks, this is a major problem. I don't think anybody out there on CNBC is talking about this. I do hear uh, people on certain podcasts talking about it, but it's the mainstream media will not talk about this. And historically, we know that once we get into this range where I call it the red zone, where equities begin to unravel. Now, something may have changed today, and that actually yesterday, and that change could be is that natural gas here, as the yield curve steepens and uninverts and steepens and moves up higher, we know that natural gas has a rip your face off rally. What has natural gas done recently? It's had a rip your face off rally. That's begun. Those wheels are already in motion. In fact, I'm going to have, I sold covered calls on an ETF called Boyle. I'm going to have those shares taken away from me tomorrow. Luckily, we have a put spread on natural gas, keeping us long of natty gas because I think it's going up higher. Now, what else generally goes up once the equity markets begin to roll over, and you can see here on the SPX, we may have the beginning on this monthly time frame, may being the operative word, may have a double top on price. Gold, you could say the same thing for, but it looks as though gold is probably going to break out to new higher highs. And generally, when the yield curve uninverts and equities roll over, like back here, 2000, 2007 and 8, 2020, S&P rolls over, gold, natty gas, bonds rallied. What did bonds do this week? They are up, and they've had a big rally on the week so far, and that's been my worst performing position, and now it's finally starting to come back a little bit. So we're beginning to see the stars align here where equities are beginning to become a little bit sloppy. You're seeing rallies in natural gas really gain steam, gold recovering, S&P wobbly, and bonds perhaps gaining a footing. We're going to go over a chart of the TLT in a moment. That's a 20-year bond ETF chart in a few minutes to see whether or not what we're seeing on a weekly basis is something that we would look to want to add to a position on. Now, catalysts that are out there that we want to pay attention to, what may pop the bubble here, and we are in a bubble, it's a debt bubble, see everything bubble, is real estate. And this is mortgage demand is collapsing. Mortgage applications for single-family homes fell to 3.7% last week, marking their fourth consecutive weekly decline. And you may be saying, I have my house. I'm good. This is not a problem for me. It kind of is. It's kind of a problem for everybody because what happens when people buy new homes? Well, they go out and buy a couple of cans of paint. They buy new rugs. They buy cleaning equipment. They hire vendors to come in and do work on the house. They buy washers and dryers. They redo their kitchens. Those workers, they have to pay money to go get lunch or have it door dashed in. The pizza delivery guy may drop off 20 pies on a work site. All that comes to a stop when you don't have mortgage demand because that means that houses aren't being sold. And with yields where they're at right now, there's not a huge demand for refis. So everybody suffers. So the index is now falling a whopping 63% over the last 4 years. This comes as home financing costs have rapidly surged inflation while prices remain at all-time highs. So there's an old saying, when you're in a pickle like this, the cure for higher prices is higher prices. So at some point in time, these prices are going to have to come in on housing because the demand is not going to be there, and those people that want to sell are going to have to cut prices. Since mid-September, 30-year fixed rate rates, 30-year fixed mortgage rates have risen 110 basis points and are back above 7%. Well, isn't that strange? Wait a minute. What else has happened during that same time frame? What has risen 100 basis points? Excuse me, what's declined 100 basis points over the past several months? Short-term yields. The Federal Reserve has cut yields. But what did longer-term yields do? They went up. What that told you was that the bond market was saying, no. We're not playing this game, homie. You're not going to cut short-term debt, continue to spend like drunken sailors, and expect us to expect a ridiculously low yield. No, we want more yield. Add to that, you have Japan and China dumping our treasuries. Excuse me. I am not going to be able to go over tonight. My voice is going. So this is a problem. Mortgage demand is at 1990s levels. And what they mean by 1990s levels was back here. This was the S&L crisis, savings and loan crisis. I bought my home back then on foreclosure. I remember it well. And it was a great time for opportunities. The problem is this was a recession back then. I think that we could quite very well be heading into a recession right now. We'll talk about China in a moment. Again, housing, home buying conditions have collapsed to levels never seen since 1960. Think about it. And what's resolved those problems? All these gray lines here. Recession. Decline here, recession of 64. Decline here, recession of what, 69? Not that I remember this. I wasn't even born then. Recession of 74. This one I remember like a son of a gun. Recession of 82 and 92. I remember that's the S&L crisis. And 2008, we all know what happened then. We're well below these levels, folks. I mean, this is bad. This is really, really bad. And all this has a multiplier effect on the economy. Multifamily homes, warning housing defaults have skyrocketed. This is unlike anything we've seen in a decade. So, I'm trying to find something else interesting here. Probability of a recession. This appears to be pretty reliable when we spike up here. This is the Federal Reserve Bank of New York, National Bureau of Economic Research. Oh, they're looking at yield curves as well. They're using the 10-year versus 3-month. I use the 2-year versus the 10-year. So basically, what we were talking about here is what they're referencing. Is this inversion of the steepening of the yield curve. All right, we'll talk a little bit about China because I'm wondering whether or not, as much as I can't stand investing in mainland China, I'm wondering whether or not we need to put some risk on here. And we'll do a little bit of research of the chart. And it's not that I'll necessarily invest in China directly. I may just invest in the economies that have big exposure to China if China expands, meaning like Malaysia, Singapore, those countries, they'll be beneficiaries due to raw materials having to go to China, etc., and do a vertical play on China using those types of trades. The reason why I don't want to buy China directly is that A, I don't believe they're accounting. There's no transparency. And B, if they ever do anything with Taiwan, every single Chinese stock is going to get seized here in the United States. It's not going to be tradable. 30% of all ETFs here that are emerging market ETFs have China in them, unless they say X China. We'll talk about one of those funds in a moment that we're invested in and we're going to look to buy more of. So, Chinese bonds are, Chinese yields are dropping like a rock. So the drop in China's government bond yields has been biblical. Ongoing property crisis, deflation, youth unemployment, failing demographic, massive debt, and the lower consumer confidence are behind China's main issues. Stimulus would be the only short-term solution. So, what's the difference between China and the United States or any other country? You stimulate enough, eventually you're going to get a reaction, an inflationary reaction. So the play here is that China is probably going to get a rip your face off rally fairly soon. And when I mean soon, this year. I don't know it to be next week or next month. So what we want to do is we want to take a look at a couple of chart setups. One, we'll take a look at the monthly chart. And we take our crayon out. And we highlight what we like. And we say to ourselves, self, is this investable yet? Franklin, Bob Crew, good evening. Yes, real estate has been hit, especially the REITs. Yeah, but they're very inexpensive, those REITs. They're one of the most cheapest areas of the equity market. S&P 500 real estate index, very inexpensive. When you don't sell your soul, you age well. Thank you. Yeah, right, exactly. Sorry about my voice, folks. I really apologize. All right, so what I like here, a couple of things. Let's begin from the bottom up. Bottom up analysis of FXI. This puts you long of China. So what do we look for? We had a long-term downtrend. Guess what? It's over. Get rid of this. Who cares? It's done. Now we start thinking optimistically, higher lows. And we identify after this higher low, where is our pivot point? Because you must have a pivot point if you have a higher low. It's right here. And then we again say to ourselves, okay, are we above it? The answer is no. Every time we've tried to do it over the past several months, this is when the Central Bank of China was very active in the markets and they ripped up higher. All we're doing here in China is consolidating these gains. And we're working through all of this overhead supply that all these buyers, long story short, all these buyers, especially these guys back here who bought, held, didn't get made whole. They held through here, saw it rally. All they want is their money back. As soon as that red entry on their trading platform turns green, they don't want to make anything. They want their money back. Get my money out. That's what you're seeing on this chart. So we, as contrarians, know that. We know what's going on here. We know the psychology of what is being played out on this chart. So we have a rules-based approach, and we say this, if this, then that. When we get a breakout above this upper band of resistance at $32 per share on the FXI, and we close there. Could be on a weekly basis. It doesn't have to be on a monthly basis, but at least on a weekly basis. Then you can begin bull operations. What is another way to enter this trade? Right back here where we did earlier in the month. That would have been a good opportunity to enter a position on FXI. So I would stay very small and then add more aggressively as we begin to break out above these resistance levels. But this $32 per share mark is truly the line in the sand on the FXI. Momentum is rising. Good stuff. And some may be out there and saying, why don't you just buy it now? Why do you want to pay more for this ETF? Because we have no idea whether or not this breakout is going to work, may fail. So until we break out and close above this pivot point at 32 bucks a share, we're still in a downtrend. We don't know whether or not the selling's all done yet. This could be just a cyclical bull market within the confines of a secular bear market. So that's the monthly view. Then we want to do a deeper dive. Maybe I'm missing something. And that's when we go over to our friends over at TrendSpider. And we program into TrendSpider. We say to TrendSpider, okay, what are we looking at here? Could I enter a position now? So what we're looking at here, these are the automated trend lines. This is the algorithm. You have a ton of support below, which we have bounced off of. The question is, do we hold it? I think we probably do. But one thing that concerns me is that momentum is declining on a weekly time frame. When you get the stochastics trading down below 50, rallies tend to fade. I repeat it over and over again. I'm going to get shirts made up. Rallies tend to fade. So be careful. They were declining back here. Anybody who bought this rally got annihilated. Anybody who chased the market up higher the beginning of last week got annihilated. We don't know how the week is going to close yet. We don't know if the support level is going to hold. I want to see these stochastics hook up, and I want to see up volume rise. So I'm not in the bull camp yet that we're going to hold the support level. It may. Daily chart. Now, the daily chart looks constructive, but it also looked constructive back here, and we failed. Let's check out seasonality. So we're in a time frame. January is the second worst month out of the year, December being the worst. But we go into a uptrend from February to April. And maybe we do a deeper, we drop off and then we rally back. I think that we're entering a period that's very interesting for China. And I think it's being reflected in XLB. XLB is the materials space. I spoke about this over the weekend as being an area of watch. And you could see that on the week so far, we've had a major breakout. If you take a look at a name like BHP Billiton, nice reversal week. We're looking to buy this, maybe. EOG Resources, we own this. This has treated us very well. It may log me out. Usually when it does this, oh, there we go. So we had a nice breakout this week. This is one where we get a retest next week. We're going to want to buy more EOG resources. So the materials space, energy, is beginning to bounce back quite a bit. I mean, energy is up 13% since late December. That's a huge move. We'll go to that chart in a moment. So there are areas here in the market that are quite bullish, even though the overall market, the traditionally strong stocks like Tesla, Google, whatever you name it, QQQ, they're kind of sloppy. It's not, the trend is under serious pressure. In fact, it's broken trend and momentum going in the absolute and utter wrong direction. It's declining. And again, this is Kyle Bass. He's a China hater. Not that he's wrong. China is experiencing a complete financial crash. This is a threat to our economy. We really need for China to buy our debt, and that'll get them out of the crosshairs of tariffs. China's 10-year government bond yields 1.65. Their policy overnight rate sits at 1.5%. Their real estate collapse continues, and overnight rate just spiked. Wow. Their overnight rate spiked to 16%. They're worried about their banks. I think you stick with the vertical plays on China. Again, that's emerging markets ex-China or material plays, XLB, etc., and you'll benefit from any recovery in China. Let's do, wow, we're already 6:44 already. Gosh darn it. I spoke way too much. All right, we did this. Bullish percent index. Bullishness is on the rise. We're still not frothy. This market could still head up higher. CRB commodity index. Folks, this is a major problem. You want to know why materials names are moving up higher? Because prices are moving up higher. This is inflation. Yield curve, we already went over. TLT, is it time to buy bonds? I'll tell you right now, if we close where we're at or higher on the week, the answer is yes, you buy bonds. Why? This is a bullish engulfing, bearish key reversal. Call it cupcakes. It's bullish. Volume could be better. Let's go to a daily chart. I wouldn't buy here yet. On a filling of any gap, on a retest of support, I would be a buyer. I do have a support level immediately above. We went over this last night or yesterday at around 88. That makes it very interesting if we close above that resistance level. Yields, very close to testing last month's lows. We're not there yet. We'll see what happens. Way too early in the week. 1 week can make a big difference. That's why I say, even though it's Thursday, we have one trading day left to go. Tips are rallying. Why are they rallying? Because real inflation is on the rise. Everybody knows it. Nobody believes the inflation data because the CRB commodity index is moving up higher. Home prices are moving up higher. Rents are moving up higher. What's moving lower? So everybody knows the government is FOS. So if yields are pulling back, that takes away the Federal Reserve or the bond market's defense from inflation. So what do traders do? They go in and they buy TIPS, Treasury Inflation Protected Securities. They want to protect their capital reserves. The dollar, reversal week. Do we break support? I think we're done here. I think that after President Trump gets in, he is going to be hammering. I'm not talking about picking up the phone, calling Jerome Powell and saying, hey, Jay, what do you think about cutting rates? No. He is going to hammer Jay Powell, to cut rates or begin to buy back 10-year, 20-year, 30-year debt to bring down long-term yields. That way it frees up the real estate market. Expect it. It's going to happen. What does that do to the US dollar? Crash. Euro, reversal week. But we're still off the highs of the week. Yen, bullish key reversal. Stuck at resistance. Interesting setup there on the yen. Problem for traders of equities is that if the yen begins to rally, remember one of the drivers of the rally in equities here in the United States for the past 20 odd years is the yen carry trade. So if yields in Japan, because they have big inflation problems in Japan, if yields and the yen go up higher, then that means that the cost of borrowing over in Japan goes up, and you're not going to be able to borrow cheap in yen and then buy stocks in the United States and get the spread. I mean, right now you could borrow next to zero on the out of the Japanese banks, and then buy U.S. Treasuries and collect the spread and do nothing. It's risk-free. But you have traders out there that borrow in yen, they buy U.S. stocks. God forbid the yen goes up or yields go up. That means U.S. stocks go down and they are screwed. That's what happened back last August when the yen ripped up higher. Remember when the VIX ripped up back in August, right here? And the VIX skyrocketed. The week of July the 29th. I'm sorry, the week of August the 5th. I was right. It skyrocketed up higher to highs not seen since COVID. That was the unwinding of the yen carry trade. So you need to watch out for the Japanese yen. Dow Transports on the week, bravo. I mean, beautiful. Beautiful. Really good week. Daily chart. Held up well today. I think they're pricing in lower yields here because they certainly wouldn't be going up if they expected yields to go higher. Dow Jones Industrial Average, outside reversal bar. Good volume on the week. S&P 500, Stokes declining, don't like that. Let's go back to the Dow. They're still declining as well. Money flow, still a little bit flat. Volume, no bueno. Let's drill down here. See how we closed out the day today. Daily view. Down day, thin volume. Equal weighted S&P 500. I'll tell you, this is kind of optimistic because the equal weighted, the broader basket of S&P 500 stocks is up 3.42%, whereas the SPY is only up 1.92%. So that what that tells you is that this week's rally in equities was very broad-based. It wasn't siloed to only a few stocks, which has been the case for quite a while now. We'll see if that continues. Trip Qs, weekly chart, an up week, up 1.16%. The question is it a broad-based rally or is it just a few names that is driving the market up higher or the Qs up higher? And the answer is no. It's fairly broad-based. I prefer this chart, which is up 2.36%, the equal weighted QQEW relative to the triple Qs. That's bullish. Small caps. Good week. And it should be good because yields are coming down. The banks, very powerful week here. I mean, this is a daily chart, but still a very powerful week. Beautiful. Technology. Meh. I mean, it can't close above resistance. I think tech is going to lag here for a while. Semis, quite possibly a breakout. One trading day left to go. We don't know what's going to happen tomorrow. Possibly a breakout. Software, reversal week. Momentum is still weakening though. Biotechs, I think we're close to a bottom here on biotechs. Staples, reversal week. Let's go daily chart. I know the daily chart looked pretty good early on. Higher lows, bullish key. This looks pretty good. I would sell puts here. I would buy this for a swing trade. Emerging markets, ex China. This ETF has no China. So this is up 1.26% on the week, whereas the EEM, which has China, is up 1.63%. So China clearly influencing the emerging market funds. The FXI, of course, is driving that because it's up 4.12% on the week. So this is why I think that we need to take a look at China as a rotational play if U.S. equities begin to roll over, and I think that's quite possible. And to avoid tariffs, here's my forecast. To avoid tariffs, the Chinese are going to be big U.S. bond buyers in 2025. They'll wait until Biden is out. Then they will be net buyers of U.S. treasuries. Why? They don't want the tariffs. And as long as they're doing the job of the Federal Reserve here in the United States, driving down yield so that way America could buy, or Americans could buy more Chinese goods, well, that's great for China. That gets them out of their pickle. So they buy our debt, we buy more of their stuff, and the old relationship that we had comes back to life. The problem is it didn't end well the last time. So unfortunately, we're going back into a toxic relationship, but I'm betting that's what's going to happen here in 2025. Energy. Now, I was long in this. I booked profits too soon. I'm now building a short position. And you may be asking, why? Why would you do that? Well, A, I'm underwater on the current short position I had. And B, I think we've gone parabolic. I think we're going to get a real ruthless sell-off here. So we began to add to our short positions here because when you get an ETF, which to be fair, has been under institutional accumulation, once that buying begins to diminish, well, then you get a reversion to the mean. And this has gone straight up 13.73% since December the 20th, not even a month. Crude. This is the proximate reason as to why crude energy is rallying. We are at resistance. I'm feeling a lot better looking at this chart about my short of energy. That short is going to be quick. I think that energy is going to go a lot higher. So we're not going to stay in that short very long. Gasoline. Unfortunately, this is no bueno. This is very, very bad. Gasoline is up 3.9. It's up 4% on the week. Natural gas, of which we are long, and a great trade here. I know a bunch of my members were in this, and we did very, very well on natural gas. We bought it when nobody else wanted it, right down here. FLNG. This is our another one of our natural gas plays. We're long of this because we have a major monthly breakout. We bought more a week or two ago, actually more than that now, down here. And we doubled up on our position. Gold, I'm getting to roll up. Wow, beautiful chart here. Gold, I think that we will be rolling up our put spread. We sold puts. We're profitable on that. We're going to roll up on price, same expiration date, and make those profits real. I think gold is going a lot higher. Let's do some chart requests. I'm going to call it, and I got to cut off tonight pretty quickly because my voice is going. So hopefully I make it through this. All right, what do we have here? Guys, I'm going to cut it off with the number that we have already in here. Why is this not refreshing? There we go. All right, so we got Rumble, Sean with his Rumble. We got Nvidia. Well, gold we just did. Bullet. Oh, you're talking about Barrick Gold. LABU. Yeah. I'm glad you brought that one up. RF. SoFi. I was just talking about SoFi. SOXL. EOSE. TBA. We own that. BTU. All right, we're going to leave it off there, folks. Oh, can't forget Polish Taco. All right, we'll leave it off there. And folks, again, if you're not currently in our forum, it's free. Trust me, you're not going to get asked for a credit card. Sign up. Great crowd. Let's get to it. We're going to be using TrendSpider. We have a 35% discount code below. Take advantage of it. You get a bare minimum of 35% off. And it's a great product. I use it all the time, obviously. And let's get to it. Rum. Weekly chart. I like it. I want to see it hold 1182. Because if it does, we may be setting up for a breakout. I like the bullish reversal bar. It's got to hold this support level. This is for Sean. So, Sean, I'm going to share this out with you. You may want to refer back to this tomorrow afternoon. Daily chart looks good. Just watch out for these Stokes, Sean. They're not going in the right direction. Just beware of that rug pull. Remember, rallies fade when those Stokes are trading down below 50. Now, if they hook up, they go back above 50, that means momentum is building. And then you should feel a lot more optimistic about the trade. NVIDIA. They report in February. Weekly chart first. I had this as a short going into the week. I still think that it's a short, to be honest with you. I wouldn't short the common stock. I would sell a call spread. For those not familiar with what that means, I would sell a 20 delta call, and then I would buy a 15 delta, a 10 delta call, and that would act as my insurance policy. And if the shares decline, the value of that call spread that I just sold declines, I pocket the difference. It's a good risk reward play to trade NVIDIA right now. I would not short the common stock. I would sell call spreads. I would not buy the stock because it's failing to break out on a weekly time frame. We got momentum going in the wrong direction. Daily chart, bearish key reversal on the day today. I do not like this stock. It's weak. It's been weak, and I don't like it. Gold, Barrick Gold, not the commodity. I'm bullish on this sector. We had been bearish for quite a while. Let's get rid of these. Not necessary. So we remain in a downtrend. Actually, no, I apologize. I'm inaccurate. A true professional will admit when he is wrong. He has pontificated inaccurately, and I have pontificated inaccurately. We have broken out, and we have pulled back, and we have reversed on the week. I would be a buyer of Barrick on a close above. It could be a daily close. Show me a close above 1633. Barrick, long. Daily chart, same deal. It's got to close above resistance. Momentum rising, good stuff, higher lows, higher highs, bullish. LABU. LABU, I'm entertaining opening up a put spread. It's just the inverse of a call spread, which I just spoke about. It's a bullish play. It is not a bearish play. You sell a out-of-the-money put. You buy a deeper out-of-the-money put. You collect the premium. And if it's put to you, it's put to you at a discount. If the shares rise, well, the premium evaporates and you make money. So it's a good risk-reward way to get long of the stock when the stock is still under pressure. That being said, weekly chart, we have retested historical support. I know there's a support level here somewhere. There it is. We have retested it. At current, we are below it on the week, but we did hit another support level. I think you could take the risk here and sell a tight put spread. I would not buy it, but if I wanted to get long, that's how I would do it, and I'm entertaining doing it, to be honest with you. So I'm very interested in LABU. So obviously, Franklin, you will know if I put the trade on, and let me know if you put the trade on. RF. Regions Financial. I believe they report tomorrow, maybe. Oh, that's right. Yeah. Yeah. The gentleman said that. So we have a breakout here. Would I buy the stock before earnings? No. I have no cushion. So I wouldn't buy it based on the technicals because the technicals mean nothing in a earnings scenario because it's a binary event. We don't know what's going to happen. So if they rally it tomorrow on strong earnings and they close it above 26 bucks a share, it's a buy. And if they dip it back down here below 22.70, if the earnings are as expected, you may want to consider nibbling. But then wait and see next week. Do we break down to new lower lows? You never know. You don't know what the whisper number is on the street. There's the reported expectations of EPS and guidance, but then there's the whisper number on the street that these guys talk about that you're not privy to. I'm not privy to. I have friends. They're privy to it. They may whisper in my ear from time to time, but believe me, there's a whole nother set of expectations out there that we are not privy to. So wait to see whether or not we break out, or do we break down, or do we retest? That's your three-stage scenario here. On any pullback, I would be very, very deliberate. Watch those earnings. If they came in as expected, you get a pullback, Stay small with the purchase, add more next week. If we begin to firm up, retest support levels, and then begin to move up higher. If it misses earnings, don't catch the falling knife, avoid. SoFi. You bet, Franklin. SoFi is getting ready for a breakout. I think this is a Jody play. This has got Jody written all over it. Jody play. We're waiting for a close on SoFi above 1670 per share. That's on a weekly time frame. We could be there tomorrow. Very good chart here. I mean, really, really nice. Nice pullback. You got momentum building. Volume is rising sequentially. Bullish on SoFi. Just keep in mind, you got that resistance level right there, 1661. You want to see a close above that mark before you initiate a new position. SOXL. Not loving it. It's got resistance, has yet to recapture it. I would wait to see how we close out the week tomorrow. If we close above 31 bucks a share, it becomes interesting. I might nibble with a tight stop below this week's lows. That's the trade. Very, very simple. If it fails to close above this resistance level at around 31.25 per share, I would avoid it. I would not do it. It's in a downtrend. Wait for the new higher high. EOSE, EOSE. Woo! Look at that. Oh, it's an energy stock. That's why. This is going up. It's going up. This is what you call a bullish engulfing bar. So basically, the story that this chart tells you, and for those not familiar with charts, they tell the psychology of what's going on with the stock. It's not just a bunch of squiggly lines. It's psychology. What's the market telling you? The market sends you signals. So what this chart is telling you is that traders this week tried to capitalize, tried to get follow through on last week's reversal week. The problem is that what they ran into was a brick wall of buyers. And those buyers said, no. This is not a supply zone. This is a demand zone. And they took it up higher. They squeezed the shorts, and we now have new weekly higher highs. So it looks as though we are going to go up higher here. Hey, Michael, I can only see the charts that you are looking at on YouTube only, and I don't see the charts where you ask about seeing a chart like an MFA. I'm sorry, Michael, I'm not exactly sure what you mean by that, because I'm looking at the screen right where your comment is, and I can see the chart I'm looking at. So if you want to shoot me a message in the forum, and you could let me know, elaborate a little bit more, and we could work through any issues. Daily chart of EOS breakout today. It's going up. It's going up. Look at the volume. NUGT. Now, I own NUGT, not as much as I used to. We sold a bunch of it back here in October. And I haven't bought any back. I did buy back some GDXJ, but we still haven't refilled the coffers on the mining stocks. It's great that we broke out last week. This week, we have a continuation move. I would like to see a retest. I would like to see a washout here, and then I would be buying back my position. We're not there yet. What I fear is that what we're getting is a short squeeze out of this breakout, and that we have some overhead supply above. So I want to see a pullback on NUGT. And I may not get it. Maybe we break out above 41 bucks a share. We close there, and I'm going to have to say, okay, I got to pay up. And that's fine. I just want validation that this downtrend is over. And the only way you get validation that a downtrend is over is that you go from putting in lower highs and lower lows to higher lows and higher highs. It's pretty simple. You're welcome, Jody. Anytime. Have a great evening. Daily chart. We closed down today with gold up big. So the correlation wasn't there. So I'm a little bit suspect of the gold mining stocks, especially if after the big move today on gold, we get a pullback tomorrow on gold on some profit taking. Maybe that'll give us the washout that we're looking up for, but I would be a buyer on a pullback on NUGT. BA, Boeing, we own this. It's one of our largest positions. It's pulled back these past few weeks, but I am bullish. They report earnings in the next 2 weeks. I think this is a wedge formation. I think that they are breaking out. I was watching a video about their how they're reopening their facilities, and they compared the reopening of their facilities this time to the reopening of their last strike, which I want to say was 1997. And by this time in 1990s, after the strike in 1997, 1998, they had already been back to pre-strike production. This time around, they are nowhere near pre-strike production, even though the FAA said you can build up to 33 planes a month. They're not doing it because they're reworking all of their processes, whether it be safety. They're making sure that they don't commit the same mistakes that they did prior because they have new management. They are doing it right. And they're also, because Airbus is not producing much, they're increasing the average age of the planes that are outstanding in the field. Therefore, they're going to be able to raise prices because of demand. The average age of a plane on average is about 12 and a half years. I think we're at about 14 years now. So the replacement cycle for private passenger jets is going to ramp up. I have a lot of Boeing, and I'm not selling it because we bought it when nobody else wanted it. It's a great contrarian trade. I think that it's going up a lot higher. So I think we're setting up for a breakout here. This looks like a bearish chart. It's not. It's a digestion of this rally, and I think we're breaking out to new higher highs on Boeing. BTU, I went over this over the weekend. Peabody Energy, I liked it going into the new trading week, and it is up on the week by what? Almost 6%. So good looking chart. I'm bullish on it. Daily chart, bullish. I think it's a buy. BTU up. This is one of our top 5 stocks for the new trading week last week. Last chart up, and I got to go. My voice is shot. Weekly chart of the semi. We already went over the semis. SOXL, same thing. We're stuck at resistance. We need to see a close on SMH above 256 per share. And I would stay small there until we closed above 264. Then I would get aggressive on a breakout. Right now, it's a show me stock or show me sector. It's got to break out. Right now, it's weak. And I don't want to buy weak stuff. I want to buy strong stuff. Unless, of course, it's bottoming out. This is not bottoming out. It could quite possibly be topping out. So be careful here. Michael, let me see if I can see your message. Oh, you're not in the Bull and Bear Banter chat room. Yeah, I see it. You're good. All right. Since Michael joined, he's been reluctant to join. All right, Michael, did you get prompted for a credit card? How quick was joining? I know there are a lot of people out there going, nah, I'm not falling for that scam. It's not a scam. All right, MFA. I like this chart. If we close out the week where we're at or better, I think it goes up higher. Momentum is bottoming out. I think this is going to go up. It's already broken out on a daily time frame. Volume could have been better, but I think we're bottoming out here. I think we're in the process of going from a bear market into a new bull market. We're not in that bull market yet. Dollar cost average in. That's the best way to identify whether or not a bottom is getting put in is, or should say identify. The best way to manage your risk when you're buying a stock that appears to be bottoming out. You want a dollar cost average in. That way you're not putting all your chips on the table and then you get wiped out on a rug pull. We hate rug pulls, so avoid it. Dollar cost average in. Bullish on it to answer your question. And Michael didn't answer my question. Okay. Trust me, Michael did not get it prompted for a credit card. Sign up. Use this link below in the feed. Again, I'll prompt it. Join the community of like-minded traders. And that's it, folks. Have an awesome night, a profitable trading day tomorrow, and a great week.